Hey everyone, welcome back to Fiscal Voyage. My name is Felix. In today's video, we're going to talk about a specialty chemical company that I personally own shares of, and I'm looking to buy more shares of. Currently down maybe about 2%, so it's kind of basically flat, and it still looks promising. They reported earnings. Things are looking good, and earnings are expected to be higher this year and the following years. So we're going to talk about the fundamentals, and we're going to talk about technically why I'm interested in buying more shares of this company. So first off, the company I'm talking about is PPG Industrials Inc. Ticker symbol PPG. It's a triple B plus credit rating. You see here specialty chemicals, and you can see here if we move the price chart, it is a kind of semi-cyclical type of company here. It have some like an 08, 09 Great Depression. It had negative earnings growth for 3 years straight. And then it had 2016, 17, 18 kind of flat earnings growth. You can see here 2%, 1%, 1%. And in 2020, it had a negative earning growth of negative 8%. In 2022, negative 11%. But analysts are expecting 6% earnings growth year over year compared to 2023, and 9 to 10% for 2025 and 2026 respectively. If we turn on the price, you can see here these stocks tend to trade around a normal multiple of 18.2 or 0.3, 18 multiple. And you can see here there's been times where the stock is under the 15 multiple, and those have been great buying opportunity. For example, here during the COVID crash, around that $80, $90 range, $100, it went all the way up to almost 180, almost 80%, 90% increase on your investment there. And I'm not expecting that kind of increase in 1 or 2 years. Obviously, that 2020, 2021 years were very crazy, but I do expect the company to price to appreciate because of earnings growth and at the current valuation. And you can see here forecasting long-term growth. They're forecasting around 7.8%, 3 analysts. So if it stays at a normal multiple of 15, you could get about a 9.9% annual rate of return at the current price. This is including dividends, which is only at 2.2. So it's a very low yield dividend company, but it does pay a growing dividend. You can see here over the past 20 years, it's been growing dividends very nicely, around the 3-4%, some double-digit years in 2016. The most recent increase was almost 5% in 2023, so I'm expecting another 4 or 5% increase this year. They do have plenty of the payout ratio is very low. You can see here around 32% payout ratio on the adjusted operating earnings. So, and also if we go here to the fiscal fitness, free cash flow covers the dividend very nicely. You can see here free cash flow is the green bar and the dividend per share is the purple. So the free cash flow covers the dividend very nicely. The only time it didn't really is in 2022, where free cash flow was $1.88 and the dividend was $2.42. But overall, it does cover the dividend very nicely. Sales revenue has been growing very nicely. You can see here almost a 4% compound annual growth rate over the past 20 years. And same thing with net income, has been growing the past 20 years around 4.7, 4.8% compound annually growth rate. So overall, it looks good. Operating cash flow, you can see here, covers the dividend, and free cash flow covers the dividend as well. So the dividend is very safe, has plenty of room to continue to grow the dividends, which is what I like, and earnings are expected to grow very nicely in the next few years. If we go to forecasting here, back to normal multiple, even if we don't, like the normal multiple was around, what was it? We had here, I think it was 18.3. So if we go to a normal multiple around, let's say a little less, around, if we go here, say 18.11, you can see here, if it gets back to that multiple, we're gonna have a 21% annual rate of return for the next few years. So that's why I'm interested in buying more shares of this company. And if we go to CFRA here, you can see CFRA gives it a buy rating with a current price of 122 and the price target, 12-month price target of 162. It has a 3-year projected earnings growth of 12%, which is real good. And let me see, do they have a fair value? Yeah, fair value is basically at fair value calculation, but with earnings growth growing, they have a nice price target of 162. Morningstar also, they haven't updated the price. You see here 16th of October, but it's at that fair price range as well. So this probably could get a 4-star rating if they updated this here. But again, if we go back to fast graph, you can see here is right at that 15 multiple, which is fair for the most part. But earnings are expected, even if it stays at a 15 multiple, you can see here you can have a 10-11% annual rate of return for the next few years, because earnings are expected to grow 9%, 10% in the next 2 years. But if it goes back to a normal multiple around 20, based on the 10-year, let's extend this chart here. So from here to the 20 multiple, you can see here around 30% annual rate of return. And this is very possible. You can see here there's been times where the stocks had a multiple of over 20. You can see here had almost a multiple of 30. Over here had a 23, 22, 23. So there's a possibility that it can get over a multiple of 20, and that's going to give us a great return of over 20% annually for the next few years. So this is why I'm looking to buy more shares. Now, if we go to the chart of this company and we go over here, you can see here, this is kind of why I like it here on the 3-month chart. It's right at the support level. If we go here, this is kind of the support level. So it was resistance. It broke out and it kind of did a fake out with the COVID crash, kind of shake everyone out, boom, and then it went higher, and then came here. It bounced in that area. It went a little lower, but it did bounce over on that area. Even if you bought it here at 115, you did pretty well. And this is kind of why I'm interested in buying more shares. It's near that moving average, the 3-month moving average, the 50 moving average around 113, 114. So if it gets a little lower, I want it a little lower, because like I said, I'm about like 2% down. I would buy maybe like $1,200, $2,000 worth of shares, but I do want it to get around that $115, $110 area, and that's when I'll start buying a lot more shares, because you can see here how it respects that moving average here in 2000, 2001, 2002, 2003, and it kind of respected here, but then it, the 08, 09 crash, but then it respected here, respected 13 moving average here, and then during the COVID crash, it respected the moving average there as well. So that's kind of why I wanted around that 115, 113 area to buy more shares. It'll give me a higher yield and a higher projected earnings growth, or compound annually rate of return for the next few years, if I could get that 114, 115 area. One thing I don't like on the weekly chart, you can see here all the moving average is above the current price. So this could be resistance. You see here how it was resistance here, resistance here, and resistance here. So there's possibility that it could bring the stock lower, and if it does, again, this is great support area in line to that 115, 113 area of the moving average of the 3-month. So this is why I want to buy more shares around that price. I don't mind picking up more shares at the current price. Maybe like I said, another $1,200, $2,000 worth of shares at current price, because it is fairly valued, potentially undervalued if you look at the normal multiple. But I would like a little lower, like I said, around $10 drop. We'll see what happens, and I would like to pick up more shares of this company. So overall, I like it. I own shares. Like I said, I'm down slightly. But I do want to buy more shares, and if it gets to that 115 area, pick up even more shares. But overall, thank you for watching. If you're new to the channel, make sure you hit that subscribe button, and if you like the video, make sure you hit that like button so you can see more videos like this. Thank you, and I'll see you guys on the next one.